Ronald, you can hold this because you're going to be the first up. So
okay.
Have you read the question from the run of play?
Yeah.
Parts of I've read parts of it completely. All right, a little bit of housekeeping to start with. So, ladies' toilets this way, men's toilets that way, food at the back, and if the place catches on fire, follow David's direction at the back, and he's waving now, and it won't happen. So, firstly, thank you all for coming to our little fireside chat here of what's hot, what's not, and what's next. Just a bit of an idea as to how I'd like this to run, because it's all about what I'd like. This is meant to be an interactive, fairly informal sort of a session because we've got a fair bit of knowledge here for our panel, who I'll introduce in a sec. And if you do have a question, chances are there's a lot of other people that will have the same question. So don't feel shy about interjecting, interacting, putting your hands up or anything like that, because I'm sure that everyone will get benefit from people saying, thank God they asked that question because I didn't have the courage. We'll also be around, there's show bags over your seats that have got pens and paper and all that sort of stuff should you wish to take a note, and also business cards, etc. from the panel here. So if you do have a question that you'd like to ask after or interact with us after because you don't want to get caught in the throng, that's perfectly okay. Firstly, I'd like to thank Finbar for sponsoring and hosting this event, whose wonderful building we are in, and who have an array of their projects displayed on the wall, and Ronald Chan, their CEO. A lot of property developers and apartment developers claim to be number one because real estate is the land of the self-professed and self-obsessed, but actually Finbar are the largest and most trusted property developer in apartments in Western Australia. And I'm very proud to be able to say that I've represented a number of their projects over the years. My name's Sven Robertson. We've got Sophie and Michelle from Joyce Property here as well. They are the leasing and property management experts. Abby, who is going to tell you all about the tax angles and the new regime that we find ourselves very suddenly in. And Michael and Luciana, who is meant to be sitting in this seat but has decided to wimp out and sit in the front row there, from Alchemy, who will talk to us about the lending and the finance aspects of it. I think, I thought it would be helpful if we perhaps started, because rather than just me talk at you or us talk at you, run you through, having spoken to a number of you over the period of time, with perhaps running through a bit of a scenario that I know that many of you may relate to, and that is this. Perhaps we'll go through a case study and run down the panel with regards to various questions. So the case study is this, and this may resonate with some of you. An investor has purchased a 2-bedroom apartment a few years ago for $600,000, two beds, 2 baths, 1 carbo. It's now worth about $850,000, has a mortgage of about $450,000, is renting for about $800 a week. And of course, I know that the government has grandfathered negative gearing, but in Western Australia, this is largely a pill to a headache that we don't have, because a lot of those properties are now cash flow neutral. They're not actually negative geared anymore, or throwing off mildly cash flow positive scenario. So the question is then, what do we do now? Should we transfer our interest and put it into an off-the-plan property where the tax regimes are quite clearly different? Can we, should we, and how does that happen? So first question I would like to pose is to Ronald. Ronald, the federal budget has preserved negative gearing for existing properties and grandfathered that in, but they've also pulled some fairly heavy capital levers in terms of new builds, very much focused on increasing new supply and those exemptions with the capital gains regimes, the negative gearing, the stamp duty concessions being extended and increased. Has this worked from somebody who's fundamental to increasing or the supply in the Perth market? How are you seeing these big changes that are meant to affect you? How's it working?
Thanks, Sven. Before Sven, I begin, I'd just like to gauge the audience a little bit. I understand a few of you are Joyce's property management. Can I have a hands of those people that are being managed? Okay, great. And of all these people who have who owns a Finbar property or apartment? Okay, so we got a few people that we can sell to tonight. But I'd like to just call out to Ian. Ian is on his 5th purchase of a Finbar property. So that gives you a good indication on how Finbar is tracking. Our repeat buys is now sitting at 28%. And it's been increasing year on year. It's because of the ability for Finbar and its brand to continue to deliver. That's the reason why repeat buys are coming back. And, we got Jupiter, right? Yeah. I always remember that name because that's a very unique name. And he recently bought at Bel Air as well. And also he introduced a few people to Romeo as well. So to answer your question, Sven, look, the government's throwing everything that they can to try and increase supply. And to give you a bit of context, why are they doing that? We are in an undersupply of the market. We simply cannot deliver enough product to the market, which is why we're seeing vacancy rates so low. When you're seeing Bel Air apartments, 1 bedroom in Belmont, leasing out for $700 a week, you know that there's a chronic shortage of product in the marketplace. Finbar itself has 30% market share in terms of sales overall, so we have a good indication of how the market is tracking. This year, we launched our Romeo project, where we saw 70% investors come into that product with 50% repeat buyers in there. Palmyra West, that's the dynamics is a little bit different with 40% investors, but however, first home buyers sits at 30%. So depending on the product that we bring in and the location of the product, depends on what kind of investor profile we have. But what does it mean with these government changes? We saw a robust sales escalation during the beginning of the year, but coupled with the Iran war, as well as the changes to or potential changes to the negative gearing and capital gains tax, we've seen a decline in sales. And I'm not going to say that it's all smooth sailing, but naturally, investors always sit on the fence. There's potential rate increases and all that. But we've been through this before. There's talks about negative equity happening. We've been through this before. But if you put a straight line through the graph, you can see that property prices over time increases. So you got to be in it for the long game. And what does it mean for capital gains tax and negative gearing? It just means people will retain their property to invest and be smarter, not buy and sell. Because people that do that, they win some, they lose some. But naturally, over the long period of time, it's about longevity and long-term growth.
I'm pleased you've said that, because as one of your agents, I often get people asking me, what do you think the market's going to do next year? Or, that very much that short-term growth. And that great investor, Warren Buffett, said, look, in the next 10 years, the market's going to do this. It's going to have a couple of absolutely cracking years, a couple of absolutely awful years, and a whole bunch of normal years in the middle. The problem is no one tells you what order those years are going to get thrown at you. So it's time in the market that's far more important than timing the market. And also, like you said, I'd rather buy a great asset at a fair price than a fair asset at a great price. So it's far more important that you buy the right property than try to get the cheapest price. Because if all that attracts you is that it's cheap, then guess what's going to attract the next person is if the greatest feature of it is cheap, you have a problem. Don't put the mic down, Ronald, because I've got some more questions for you. For a developer, and obviously with a very broad view of the market, what configurations, price points, complex amenities, when you're looking at a new project and to put it into the market, what are the things that you're finding that are endurably desirable in those projects?
It's a project location and product offering that comes in on top. We've done everything that you can think of, when it comes to a project like Civic Heart, where the floor plate is so big and the ability to provide as much amenity as you can within the area. We have a brainstorming session where we talk about, should we put a dog wash in there? Anything that you can think of, whether it's absurd or whatever, we'll put it in there. But it depends on space, depends on product as well. what kind of people we want to pitch to, demographic, first home buyers. But naturally, amenities, they help with your overall asset and appreciation over time. It helps with your rent. Buyers that want to come in, they always tend to move around. They always want to get into the brand new property and all that with the amenities. So that's the reason why some projects, amenities are higher and some amenities are just as standard. For example, Palmyra West, we've provided as standard on all developments that we normally do is provide the swimming pool, the gym, the residence lounge. And, a lot of people are happy with that. The gyms are always the number one use, residence lounge, where people want to carry out birthday parties and all that. But certainly the three fundamentals as a standard is what we provide, those three. But we've gone with Garden Towers, a golf simulator as well, a putting green, a yoga, outdoor yoga, it's quite extensive. But what we want to do is try and keep it as a minimal moving forward. We realize strata fees, could be an impact on some people. So try and reduce that in amenities. Strata fees is probably another question that Sven would ask, but the volume of apartments that we deliver in a development means how much strata levies get spread across the job. So if it's a small project, then you tend to see strata levies a lot more higher than normal.
Yep. So, when people are buying off the plan, they're really making an exchange of promises. They promise they're going to buy it. The developer promises that they're going to build this wonderful thing. And every developer says, this is world-class amenity, 7-star. I don't know how many stars there are, but I'm sure we're running out these days. What are the things that buyers should look for when they are committing to an off-the-plan project, given that it is something that's happening in a few years? And how does an established developer like Finbar manage and reduce those risks to perhaps somebody who's making promises that have never been kept before at all?
So for the people that have bought Finbar properties or multiple, we always provide a survey on it. We ask their age, what they do. And one of the fundamental ones that I always watch is the reason why they buy. And there's always three items that always comes on top: location, price, and developer profile. Now, we've been in this game for 30 years. We've delivered 100% of projects across the board. Buyers in these days are astute. They know, which is why we see a repeat buyer profile coming to 28%. Our contracts are fixed price. We don't have any price escalation clauses in there. Ultimately, our selling agents are people that work closely with us. They know our contracts. They know how to convey to buyers. And there is that trust that we deliver. People know that when we launch a project, generally it takes less than 2 years for us to deliver, faster than you can build a single-story house. Bel Air, it took us 12 months to complete from ground to completion, and that's delivering 200 units in there. So what answers your question, Sven, is track record, and that's what we have.
I suppose as one of your agents at the front end, I can certainly reinforce that it's very comforting to be able to say that this is what you're going to get, and know that that's what they're going to get, rather than it gets renegotiated, changed halfway through. And I think, as many of you here can attest, because you've touched and felt it before, with confidence what's going to move forward. So I suppose if you are looking, the long and short of it is, if you're going to look at buying something off the plan, buy it from an established developer who has that track record, because at the end of the day, it's a promise. And a promise is only as good as the people that make it. So you want to deal with people that have got a track record of keeping their promises, not hopeful. Perhaps pass the mic to, thank you for that, Ronald. Do we have any questions for Ronald? Because he's probably the only one that doesn't have his business card and mobile number in the show bag. So if you do have a question for Ronald, now would probably be a good time.
If you Google me, you'll probably be able to find my phone number.
No, okay. So Abby, hit me.
If you're buying off the plan and 50%, less than 50% has been sold, how long it takes?
How long does it take for us to sell 50%?
How long does it take to get the apartment for those who have already paid?
Okay, I can answer this.
Yeah,
'Cause
okay.
it's a question about So you're talking about pre-sales. Okay, and this is where Finbar is different from the market as a whole. So most developers that are not listed companies will have a minimum pre-sale threshold that they will have to achieve, which is determined by their bank, to achieve finance before they can start construction. Finbar starts much earlier than most. It's normally, 20-25% of sales?
Maybe you shouldn't answer that question. It's a little bit a trick questions, but our contract says 50%, but we have a bit of confidence once we achieve 30% sales, then we're comfortable that the project is there, and we tend to have the ability and a large balance sheet to continue the project. So we may have a clause in the contract that says 50%, but generally in all our projects you'll find that we probably commence faster, because what that means is that we're a public listed company. We can get the projects completed sooner and come into the financial year. So we have as much interest in it than anything. Additionally, we want to do the best thing that we can to our buyers to fast track projects. We don't want to have our buyers sit on a contract for 2 years or 3 years before a project actually starts. And that's one of the fundamentals why people continue to buy with us.
Was it the same for the building which is coming up opposite Boot House?
Garden Towers. So Garden Towers is a bit of a tricky one, because if you recall, we went through COVID. We launched that project in April 2022, but because of the capacity at that time when we had Civic Heart, Aurora, The Point, we had 4 projects running at the same time, and labor, as you recall, during that time was constrained. We had 40 to 50% increase in construction costs. So in terms of managing it correctly, that's the reason why it was delayed. So that project is going to come to about 4 years before we complete. But when we started construction in April 24, that time frame now, you can see that time frame is short. Did you buy one at Garden Towers, or are going to buy one?
I was living in the Boot House, so I could see that.
Oh, okay, yeah.
Do you have, with your contractors building for you, do you have any or see any challenges in that market in terms of is there healthy competition in contractors bidding for that kind of work, and are there any delays or challenges in that construction process for you guys?
Yep. Okay. So you have to probably look at the dynamics of how the Perth market, the construction is happening at the moment. We're in a undersupply. We need more supply. There has probably been 2,000 insolvency in the construction industry, lack of labor, lack of skilled trades, which is number one. A lot of other builders tend to go on a subcontractor model, so they rely on subcontractors. Our builders obtain labor directly through labor hire companies, obtain the materials, and then directly carry out the work. So their dynamics is very different, and a lot of builders don't follow that. I mean, our builder Hanson's has 700 people on their workforce at the moment, just doing labor work. But, we are constrained, or they are constraints as well, in terms of the deliverables. Skilled labors and productivity is certainly at a low at the moment. And with a project like Garden Towers being so large at 2 different towers, there tends to be people, you're looking at 300 people on site. It's very hard to manage people like that. So we need more skilled labor is what we're seeing, and there's challenges in that part.
Yeah, fair enough. I'm familiar with the construction challenges. It's how I wondered how that impacted you guys in sort of commercial building space.
Yeah, same thing. With skilled labor, things are taking twice as long to do, which is why you're seeing that time frame. But if it can be managed correctly, I mean, we're seeing that tailwind happening at the moment where projects like our Bel Air projects are finishing off. So people that have trained up, who are retained, are skilled up, and they move on to the next project where they can carry out jobs at their best. But initially, when you have that initial workforce that comes in, you tend to have a large volume of people moving on, going up to the mines or something like that, because it's much more robust in terms of pace.
Yeah. Thank you.
What's your view on supply going forward from the budget changes? Like, will that accelerate supply, or no sort of change from the budget changes?
At the moment, as I mentioned, we're seeing investors probably see so at the moment. I mean, our yearly investor percentage is sitting at 43%. Last year was 40%. The year prior was 50%. Naturally, as I mentioned, people will sit on the fence until they get more clarity on where things are heading. But one of the main things that I always tell people is that they should actually do something now rather than wait until something happens. Because certainly the tap has shut off or slowed down, but when the tap can turn on open very fast, and by the time that happens, you're probably going to be missing out on properties because there's certainly not enough product to bring into the market. You look at East Perth in itself, our Garden Towers project is the only one with a crane in East Perth. In this market, you should be seeing more construction happening, but you're not. The other item that is probably more fundamental is the type of product that is being delivered in the market. You're seeing a lot of high-end 25,000 square meter luxury apartments that is happening out in the western suburbs. It's because those kind of projects work for those developers, but they're only a select few. What Finbar is wanting to focus on or is focusing on is the 80% of the market, which is the more affordable range.
Gentlemen, yes?
So if you see the whole trend of the Australian dream of owning a home, is it shifting towards apartment? Because if you see historically, 60, 70 years back, Shanghai, Singapore, Mumbai, they were all houses. But now you see huge amount of apartment. Will that happen in Perth, you reckon?
Yeah, I mean, we're seeing buyers certainly, by the time they want to secure a piece of land, 15 minutes away from Perth, whether they can secure a piece of land, and by the time they get approvals and all that, they're looking at 2 years, like I mentioned, to even build a single-story house. People are buying apartments because they don't have that time. They get certainty, which is why they're buying. But naturally, we're probably going to see a shift in apartments. We have buyers coming to us saying, do you have any planters or anything in that? Because I don't want any of that. They want to enjoy their lifestyle. They don't want to look after the gardens or anything like that. So naturally, as population growth, amenities increases, you see more cafes, more things for people to do. Public transport will increase. So naturally, people will shift to apartments. It's just about our product in the marketplace.
You also find that cities as a demographic grow out to a certain point where they then stretch the limit of their civil infrastructure and resources, and like just the commute to go from the farthest points to back into the city becomes prohibitive, traffic congestion, etc. And then they grow out for a while, and then they start to grow up. And go through that inflection point, which I think is close to sort of the 2 million person mark, which Perth went through a few years ago now. But you can look at Sydney, Melbourne, and the evolution of all of those cities, especially since the advent of the car. Let me say that. A lot of European cities, because they were built on walkability originally, because they weren't designed around cars, have in some ways coped with density better than we have in more modern cities in Australia. But what you see, though, is like on the American model that we have with the car model, they grow out to the point where the congestion, the infrastructure, the getting in makes it a terminal limit where it makes no more sense. And then you see government policies that then say that they want to see more infill and a more intensive and efficient use of existing civil infrastructure than continually moving further out. And Perth went through that inflection point a few years ago now, and it manifests itself in a whole range of ways.
Thanks.
We should probably carry on, otherwise we're going to be here all night.
Yeah, we're here all night. Okay, so Abby. Abby, we've got our investor. He's got his apartment. It's marginally cash flow neutral. He wants to get something in the golden glow of the new supply. Can he recharge his negative gearing somehow? What can they do? Do they have to sell, realise it, and then to move it in? Or help me out here. What am I doing?
Okay, thanks, Sven. So to begin with, I think let's start with the tax changes, what the government has proposed. So government, through the budget on the 12th of May, they've grandfathered all the investors which held property on the 12th of May 2026 for negative gearing and capital gains purposes. Okay, so what that means is if a property, let's say an apartment, was negatively geared, on that day, investors can continue to keeping the negative gearing benefits. They can offset the loss on that rental property against their employment income, business income, other investment income to reduce their tax bill. That ability has been taken away from the budget night for established houses, right? But anything that we're buying a new apartment off the plan, townhouses, anything that increases the supply, investors do get to keep the negative gearing benefits and the capital gains choice as well when it comes to like 50% discount or indexation model, what the government is proposing. Right. So coming back to Sven's question. So investor is cash flow neutral. What that means is the rent is equivalent to the costs of holding and running the property, right? Mortgage costs, running costs, water rates, council rates, strata, and everything. So what can we do to re-gear the loan on the property? That's the question.
Yeah.
Yes? So pretty much we can borrow against the property to increase the gearing on that property, right? Let's say the loan on the property is only 400,000 and now the market value is 800,000. So the bank says, I'll lend you another 200 grand, you can do what you want, okay? You can increase the borrowing on that property, but it doesn't become tax deductible if the use of that funds is not for an income producing asset. So what that means is you have to borrow the funds and use that to produce an income, buy another apartment, and then you can start deducting that interest. But it cannot be tax deductible against the current property which you borrowed against. The use of the funds is the key here. What are we using those funds for? Does that answer?
So in other words, I can borrow the money, buy an off-the-plan property or a new supply property, and that component of debt can get offset, though, against that new property.
That new property, not against the current property which we held and we borrowed against.
So let's say, for example, that property isn't going to be delivered for
2 years.
Or let's 2 years, let's say.
Okay.
And so it's my intention that it will be rented out.
Mm-hmm.
Right now, it's not available to be rented out. That cost, what happens with that?
Okay, so that is like a holding cost. You have to capitalize that cost. You cannot deduct it. So what that means is, in plain, simple terms, is the apartment costs $1 million, let's say, that new property. 2 years holding cost for the interest is 70 grand, 60 grand, whatever the number is. That goes on the cost base of the apartment. You cannot deduct that interest cost against your other sources of income to reduce your tax bill because that property is not available for rent. So those funds were not borrowed for an income producing purposes at this stage. They will be producing an income, but for 2 years once the property is delivered and someone's renting it out, but not today.
But
you don't miss out on the tax benefit. It's just a timing issue. It gets added onto the cost base of the property. So the $1 million cost base of the property becomes 1.07 million, 1.05 million, whatever you spend on the borrowing costs. So when you sell, that gets offset against your sales proceed to reduce the capital gains.
so it becomes a deferred event.
It's a deferred event. It's just a timing issue. You're not missing out on the tax benefit, but just today, you don't get to claim the benefit because the property wasn't available for rent.
That new property which you buy, the addition $200,000, that new property when it is available, what is the tax benefit on that one? Is the negative gearing?
Which is the 6%.
If I keep it for more than 2 years, because the government does not want me to sell it off straight away, that's where I get stuck. But if I keep it for more than 2 years or 3 years, then is the negative gearing continued from that time?
Yes, as long as it's a new property off the plan, yes, you get to claim the negative gearing and the interest costs on that property.
I can't buy an existing house somewhere with that money.
No, you can buy with that money, but you can't get the negative gearing benefits.
I got to go to Finbar,
Yes,
put a deposit there,
yes,
and that is available for negative gearing.
yes, because it's a new supply. It's a new apartment. That's what the government is intending to do. They want to increase the supply and stop the investors from buying established houses and let that market for first-home buyers, basically. That's what the intent is.
Yeah, okay.
Yeah.
Well, they're pulling the capital levers pretty hard in that. So let's say then, so we can put an example together, of that $200,000 of debt at 6%, so it's a 12 grand cost, that goes onto the cost base of the new property that I'm buying. So whilst I can't claim it against today's income, when I go to sell, depending on whether I elect whichever regime I elect in the end, whether it should, because I cannot, is that correct? On a new build, when I go to sell, I can say I want to do the 50% or I want to do indexation, whichever suits me best.
Yes. Okay. So let's talk about two scenarios here. Okay. So we bought an off-the-plan Finbar apartment for $1 million. It took 2 years to construct. We paid $12,000 in holding costs on the interest for 2 years, right? $6,000 each year. So now your cost base is $1 million, what we paid to Finbar, $12,000 for the interest, stamp duty, settlement agent costs, and all that. That's your cost base. Let's say adding up all that together, it's $1.1 million, right? You sold it 10 years later for $2 million. Now the capital gains is $900,000. That's the difference between what we paid, the cost, and what we sold it for. Now we have to deal with the capital gains on the $900,000 gain that we may have made. Okay. For the new supplies, which we have acquired after the budget night of the plan apartment, anything new, government has given investors choice to select their capital gains method or the rate. So the first one is standard, which was from the old regime, which is the 50% capital gains discount. So how that works is you have a $900,000 capital gains to report and pay tax on. You halve that gain. So that becomes $450,000 and we pay tax on that. Simple, at your individual marginal rate or whatever your structure is, right? Or in the new regime, what the government is saying, property investors who are adding to the new supply, buying new apartments, townhouses, newly built, they have a choice to use capital gains 50% discount method or a CPI indexation linked method. So what that means is your $1.1 million cost base is increasing every year linked to the CPI, which the government will be giving out the data, 4% every year, 5%, whatever the number is. So what that could do is in 10 years' time, your $1.1 million could become $1.4 million. It's indexed through the inflation. When you sell it for $2 million, that's your cost base, 1.4, and you pay tax on the difference, 600,000. But under the new regime, government wants the tax rate to be at least 30% minimum. That's what they've done. But at least the investors buying new properties, they have a choice to use the old regime or the new regime.
And they elect that when? At the time of sale?
At the time of sale.
Okay, so you can then look back in retrospect and go, this would suit me better than that, and you have the ability to make that choice.
100%. The accountant does the working, someone like us. Scenario A, old regime. Scenario B, new regime. Which one works out better? We go with that. It's as simple as that.
So let's say now then we buy a second-hand apartment, just to contrast those two things. And I don't have any of the holding because I can settle it immediately. I've got that $200,000 that I've used as the deposit. The rest, let's say it's $1 million, and I borrowed the rest. What is that? What can I tax deduct?
Okay, so the property costed $1 million again, right? So we borrowed $200 against our existing property and $800 for the new property. So the borrowing is $1 million. So the entire interest on the $1 million borrowing is deductible against the new property, not the existing. So that's step one, okay? But if the rent is not enough to cover the holding costs, which it won't be enough if you borrow $1 million in today's time, the loss that we are incurring on holding the property, you cannot offset against your other sources of income. You can only offset if you have a positively geared rental property. So you may have a house, investment property, fully paid off. It's giving you $50,000 interest every year. Residential, commercial, it could be anything. As long as it's an investment property, you can deduct the loss against the established apartment as well against that property. But even if you can't, let's say you don't have any other property. This is the only property we have. You don't miss out on this. This loss just gets carried forward for future. So when the property starts making a profit, you get to offset against this loss. If we can't offset it for next 10 years, it's still producing a loss, you get to offset it against the capital gain, which we may end up making 10 years from now, 20 years from now, whenever we sell.
But I can't offset it against my income.
No, it doesn't help with the cash flow today.
What happens?
In today's time? Commercial property off the plan. Yeah. Okay. You still get negative gearing on that? 100%? If I buy an established commercial property, I still qualify, they come under the same scenario. Yes.
So clearly the negative gearing then heavily favours, and also let's briefly, it goes against your cost, but your capital gains is only indexed. You don't have that flexibility of choice. Is that correct?
If you're buying an existing property, yes, you don't have a choice. You're in the new regime altogether. Old regime of 50% capital gains discount is gone for established property. The choice is only if you're buying a new property.
So it's definitely more favourable then from flexibility and tax and that sort of stuff, that the new property or something that is defined as new supply is unequivocally more favourably
100%. That's the government's intent. And this special concession of the choice is not available to business owners, share investors, nothing. It's only available to property investors who are buying new builds.
Odd that we happen to be in a property developers seminar. Is there anything, when they're releasing this deposit to buy the new property, is there any particular way the borrowing should be structured to make sure that they are, from the accounting perspective, allocating, not mixing or contaminating their costs?
Very good question, Sven. I see these people getting wrong every day, all the time.
You should speak to him before you buy.
Before you buy,
Before you
do
speak
something.
to your accountant, not at the end of the year.
Before you refinance, before you sign any document, come and speak to us, not after.
His
All right?
card's in the bag.
Yes. Okay. So we are refinancing our current property. How should we do it? So let's say the current property you own solely in your name. Okay? But the new property that you're buying is a jointly held property. Could be in a trust, could be in a company, could be in a different structure, right? So the loan has to be documented. So you as a borrower, investor A is borrowing to lend it to this property acquisition, to fund this acquisition, right? The interest has to be deductible against the new property, not against the current property. And please make sure the bank starts a brand new loan. They don't mix it against the current loan. It's not a redraw on the current loan. So the current loan was 600, they've given you 200, so the current loan balance becomes 800. No, we're not doing that. It becomes very messy from accounting and tax point of view because we have to apportion and prorata the interest, which portion is tax deductible against which property. So please keep it clean, document it. If it's sole owner for a current property, but it's jointly held property, the new one, please document it. You are on lending that money for the new investment, and there are tax reporting consequences how we deal with it. But we can speak about that in detail personally.
Before, because I think we'll move on to finance next, so we don't, so we have time afterwards. Is there any other questions for Abby here to solve your tax problems in August? No. Okay.
No.
Hang on, I've got one.
Oh,
if you don't mind.
Yeah. The panel can ask questions too.
Abby,
Sure.
if I wanted to purchase in a company structure for a new apartment, what would be the tax ramifications of that under the scheme, given that I can't essentially negative gear against that company, but what I could potentially do with the losses that accrues and any downstream profit?
Okay, so buying property
Asking
in a
for a
company.
friend.
So this property, what we are buying in a company, we always have to remember will always be an investment property. If the plan is you could potentially be living in that property 10 years down the line, once we all retire and downsize and all that, please don't buy it in a company because there are fringe benefit tax implications. So be absolutely sure on day one, we're buying it in a company because it's solely investment purposes. Yes, you can do it in a company. Now, because this is a passive investment holding company, it's not running a business, right? It's an investment company. It will pay tax at 30% flat. Whether you make $1 or you make $10 million, that's your tax rate. You can negatively gear and you can the property, but if the company doesn't have any other income in there, you can't offset those losses anyways. They're stuck in the company until the day you sell the property and make a capital gain to offset those losses. Again, it's a timing issue. Impacts the cash flow. You don't miss out on the losses, but they just get carried forward.
In fact, you can grab the mic for now. You're up.
Yep, no other questions? All right. Mike, here we go.
We will be available afterwards, so if you want to come up to speak to any of us individually, feel free. I'm presuming that no one's got homes to go to or families. All right, so Alchemy. I like the name Alchemy Finance because we're turning lead into gold. So the apartment's gone up in value. The apartment's gone up in value. Talk to me about how banks. You can't just borrow 100% of that. I'm presuming. What are how are banks treating increases in value when you're trying to release that both off the plan? What are they doing that's different now than they did before?
Well, nothing's really changed there, thanks, Sven. What you can effectively do is if you've had let's say a $200,000 increase in the value of that property, you've basically got access without paying mortgage insurance. Does everyone here know what mortgage insurance is?
Perhaps give us a
quick show of hands if people know what it is. Okay, we'll give a quick explanation of that. Basically, mortgage insurance is you paying a premium for the bank to protect them from yourself. So we try and avoid mortgage insurance wherever we can. So as soon as you borrow more than 80% of the value of a property, mortgage insurance will kick in. There are a couple of unique lenders out there that will go a little bit above 80% and not charge it. But as a general rule of thumb, you'll pay mortgage insurance and you get no protection from it whatsoever. So it is something you want to avoid. So broadly speaking, we'll talk in terms of 80% value of the asset. So if the apartment's $800,000, you've effectively got 640,000 available to use against that. If you've got a mortgage of 400,000 on that, then you've got 240 usable equity. So you can then use that to go off and leverage against another asset, which you can again borrow 80% from.
So are the banks these days treating, so that's good with the asset. Talk to me about what they look for as far as serviceability and any changes that they may have had between previously being able to use negative gearing against your income, now not on second or existing stock. So pre-approvals and what the bank's prepared to lend with regards to serviceabilities.
There were a lot of pre-approved buyers that were quite upset after the budget announcement because a lot of those pre-approvals got torn up. Most borrowers that Luciana and I see are heavily reliant on negative gearing. And I guess the thing with negative gearing, it's not eternal, it's a moment in time. So that negative gearing might help you get across the line for the first 5 years or so until that property becomes positively geared. But the removal of it, we're seeing, I've heard up to 30%. I ran a few scenarios and the largest amount I got was 19%. But if you're thinking in terms of borrowing and $1 million apartments, that's $190,000 that you can't borrow effectively. So yeah, it's been huge. So being able to buy an asset that's negative geared and being able to lean in on negative gearing just increases the participation rate for investors. So yeah, that's something that we were quite upset that it was done. I'm sure a lot of people in this room are upset because it's hard enough to invest and try and make money, let alone, they're lifting the bar on you.
So would it be fair to say then that the banks are not participating, but that the capital levers with regards to both taxation, the bank's appetite to commit capital to, etc., new build, new supply is substantially more robust than it is than existing supply, and certainly that existing supply has fallen out of favour as far as its treatment by banks, its treatment by the tax department, etc.
Well, it's just about accessibility, that one. The negatively geared properties are a lot more accessible than the non-geared properties because you're having to carry all of that tax burden yourself. You're not getting a discount on your taxable income.
So we've got investors like, and now that anti-money laundering's come in, as I always say to people, you need to be confident that you can meet your obligations when the time comes. And, most people buying an apartment off the plan will at least require a bank to participate in that settlement. Not that many people have $800,000 in a suitcase under the bed, and if they do, don't give it to me now that anti-money laundering has come in. So what does a borrower need to think about, as far as their own planning and to make sure that they are going to be able to obtain finance in the future, as far as buffers, what the bank looks at as far as things that reduce your ability to, don't get a big credit card limit because they're going to look at all of that and that's going to hurt you. What are those sorts of things that borrowers need to be aware of in their time between when they make that commitment and when they look to apply for that finance and settle?
The big one would be preserve your equity. If you can, preserve your deposit where you've got it. Most people are putting down, I'm not too sure, what is it, 10%, 5% at the commencement of the contract. And most people that are going to buy an apartment off the plan, it's normally not their first property. They're normally leveraging against existing property that they already own. So yeah, it is just really a matter of having a good discussion with the client, setting a pathway forward, and they'll know exactly what they need to do in order to get the finance across the line. We'll try and factor in a few scenarios. What happens if interest rates go up? How is that going to change things? And the customer will know where they sit in terms of income and how affordable it is for them.
So we hear that banks, if you like, stress test the loans that they're lending at X%, but they theoretically also consider that interest rates may rise. What kind of, if you like, expectation or buffer if somebody's considering their capacity in the future, should they, everyone goes, oh, the interest rates are X, and do you think they're going to go up 25 basis points or down 25 basis points? Is there a kind of rule of thumb that a buyer should be looking at before they sign on the dotted line?
Well, they're definitely not making it easy for anyone there. At the moment, anyone borrowing from a bank, they're getting assessed at 3% above the current interest rate.
Right.
So if their interest rate's delivered at 6%, they're going to be assessed at 9%. There are a couple of small non-deposit lenders that will go down to 2% in some cases. But as a general rule of thumb, we're still sitting on the COVID buffers that were put in place when interest rates were a little bit too good to be true.
Yep.
And I dare say if there's going to be any movement in lending that's going to be impactful for most people, it's going to be the reduction of those APRA buffers at
Right.
3%. They meet twice a year, unfortunately, but it's been deemed to be irresponsible for them to reduce that in the post-COVID era because the property markets were very hot. But I dare say over the next year and a half, they should come down a little bit as well. So that's going to make things a little bit easier in the absence of gearing for some and higher interest rates for others.
Do we, just out of curiosity, like in America, they talk about having a lot of fixed rates suddenly becoming unfixed and going up, etc. Are you finding that much in the market of clients that you're talking to, that they're living on long fixed rate, cheap interest rate loans that are suddenly becoming unplugged, or is that kind of washed through the market already?
Well, mine disappears on the 27th of this month, but...
Not counting.
Most of the people that fixed during the record low COVID rates, their 5 years is just about up now anyway. You might see a few that will go into next year, but unfortunately at the moment there's not really many good fixed rates around. You normally have to wait for the bottom of the cycle for those ones, but... for the time being, if you're on a low rate, enjoy it. But there is a bit of shock coming at the end of that one, unfortunately.
What's the differential that you're seeing in the market at the what level of the fixed rates coming off, just so we can be jealous for the good times that they've had? Typically,
I've got a 5 year coming off at 2.49, but
throw food at him, get food, throw it right at him.
It was ridiculous. I think, the cash rate got down to 0.15%. So we won't see times like that again. And I would have bet everything I owned that we never would have saw it in the first place a year before COVID came.
It's about predicting your future, isn't it? Like no one thought when COVID came, we all thought it was all going to end in a disaster and the property market took off. Didn't see that coming.
Now we have such catastrophes as Labor governments and removal of investor incentives.
Where are you guys seeing, or what's the bank's, let's say, 2 year view on typically on interest rates?
Well, the fixed rates are a pretty good indicator of that. And for anyone, I suppose, out here contemplating a fixed rate, at the moment, you wouldn't be doing it for having a win. It'd just be something that you'd do for comfort and knowing exactly what you're up for a set period of time. But we are starting to see fixed rates come down, very, very painfully slow, but... Yeah.
So what's spot, what's fixed? What's the difference?
Everything's sort of assessed the same as the bank in terms of servicing, but you're probably looking in the mid 6 range to low 7s for 2 to 3 year fixed rates at the moment.
And for variables?
Variables for your owner occupier, a good rate would be around 5.99, for an investor around 6.19. But the averages, you're probably seeing about 615 owner occ and say 625, 63 investor.
Pretty much if anyone's got a rate higher than that, you need to review it. So that's kind of where most of our clients are sitting at the moment.
Yeah, banks will do a neat little trick. They'll creep out their discounts, so they'll keep increasing the amount of their discounts every few years. So if you're not having a look at your home loan every 12 to 18 months, you definitely should be.
Some lenders are a lot better at client retention than others. So we see it quite often where they'll give you a great deal to get your business and then slowly it does creep and they don't work too hard to keep your business. Obviously every time you refinance it does take a bit of effort and it does cost a bit in the way of fees. So you really want to make sure you are making a good decision with your first lender that you're starting with. And then it's our job to review and make sure that it's always on a good rate. It's always working for you.
I find it personally disheartening when I log on to my banking and see on the cover page that they're giving the new clients the rates that you're not getting as you log in. It's a wonderful piece of client retention there. Look, to keep things moving, let's go on to the young ladies at property management, because at the end of the day, whilst we all talk about negative gearing and positive gearing and all that sort of stuff, it really is about the income that the property can produce and will produce, which is squarely in your wheelhouse, ladies. So how do you determine what the right rental price is in a changing market, or when a new project comes to the market for rent? Either of you.
Please forgive me if I refer to my notes. Look, there's a number of things that we look at when we're looking at pricing, much as there is, when you're pricing a property for sale. But certainly in terms of lease, there are several factors. First and foremost, we're looking at what, the leasing market fundamentals are at any given time. Knowing what they are when you're pricing a property gives you a level of confidence in your pricing. If you've got a really strong and robust pricing strategy where you are able to do the research, you are using the tools at your disposal to find out what has leased, how recently, for how much, how many days on market, all of those factors, then you can, generally feel pretty confident in your pricing. One of the other things that we pay particular attention to is, not just focusing on what has leased in the last week, in the last 2 weeks, as much as that data is valuable and it sets good precedents to review. It's not everything. We need to look at what's our competition this week. There's no point looking at data and going, great, there's no reason why we couldn't get $800 a week. Sure, property B might have got $800 a week, but it might not get that this week. And there's so many reasons why it might not get that this week. And that could be this property's got, it's two, and just referring to, say, apartments for the purpose of the exercise, this one is 2 levels higher. This one has city and river views, or it might have a pool view, or it might have a garden view, or it might have better natural light, or the owners might have got the owner upgrade at the time of purchase, and it's got the fridge and the microwave and heated towel rails and what have you. So there's all of those little things to look at. One thing that we do notice when, they're sort of suddenly coming to market all at once, it can get a bit overwhelming. So making sure that you're taking that time to analyse all the data really, really well is so important, because everyone's obviously wanting to get the best return on their investment, but having a property sit there for several weeks on end, not providing any return on investment is not what we want, and it's not what you guys as investors want. So it's really drilling down and making sure that pricing's correct, watching what's happening closely and making any price reductions or adjustments within a short space of time. That's probably the main.
Thanks for that. So when you're managing, because I know that a lot of the times buyers, and probably the tenants would be the same, that they can fixate on bedrooms, bathrooms, car bays, the stats without necessarily looking at the more holistic picture. Are there characteristics of facilities, etc., let's say that are typical in a lot of Finbar projects that really make a difference when it comes, like, are pools that important, are gyms that important? Is that those things that are beyond just beds, baths, car bays?
100%, yes. Yeah. And I think, as Ron alluded to earlier, you've sort of got those golden three that everyone kind of expects to have any quality development, which is the pool and the gym and a nice resident lounge. And then if it happens to have any, extra bonuses like a dog wash or a sauna, or a spa, or like Civic Art's got a library. They are very much nice to haves, but those first three are sort of an expectation, I think, on anyone investing in a high quality development. Bedrooms and bathrooms, yes, of course, a couple with no kids or a single person, they're quite happy with a one bedroom, but they could easily, if budget permits, want a 2-bedroom because, Auntie so-and-so comes over once a year to visit and they need a second bedroom, or whatever, or they want to study because they work from home. So there's all different things that people consider, but those amenities are
Talk to me about studies, because I've found in sales that having that extra little bit that means it's either not on your kitchen table or in your bedroom, really, certainly post-COVID where people work from home more, it's only a few square metres, but it really changes sort of the functionality. Are you finding that tenants are also looking for that same ability?
Absolutely, yes. Preferably in the form of a second bedroom, so that it can double as a study. But I know, there's developments that have a study nook. Sometimes it might be, almost sort of double as a storage closet because it is quite small. It certainly wouldn't be a second bedroom, but the fact that, it might have a door on it or it's, a dedicated study space, it definitely adds value.
And office, sort of the ability to have some sort of like a boardroom or office
without a doubt,
inside the building?
Absolutely, yeah. We get a lot of feedback about that, and when I take people through and I'm showing them the amenities and they see those office, the boardroom spaces, a lot of the times their faces will light up.
Yeah, so they can meet people in the building but not have to take them into their personal space.
Absolutely, and they can feel, quite proud of the space that they're bringing them into as well.
So shameless self-promotion, say that quickly, shameless self-promotion time. Joyce obviously does a lot with Finbar and understands their projects well. What are the advantages of going with a property manager that is active in a building, understands the building and has a lot in there versus perhaps somebody, because I know that some people say, oh yeah, but they've got others that they're leasing in the building, they won't focus on me. So what are the strengths that Joyce brings?
So I'm pretty sure there's someone who've got a property with different agency. So you will see we've got a couple.
We're not letting them out of the building. Like they either convert
we've
or
got
you're here till the morning.
We've got a couple dot points that they are very that bring strength to Joyce. So we've got dedicated leasing team who works 7 days a week. And also we start proceeding applications on Sundays, so we can present them by 12 o'clock on Monday, and that minimize the vacancy rates and maximize, the lease properties faster. And we also have strategic leasing approach. So that's including marketing, premium marketing, and we also have executive clients, corporate clients, and we work with relocating agents, so we can reach them before going to the market to achieve the best rental outcome. We also have an experienced property manager team. Most of our property managers have been with Joyce for over 10 years, so provides consistency and also expertise, advice, and long-term relationship. And also every owner has one dedicated property manager. So it's not like every week someone else will keep contacting you, and if they're on annual leave or you can't contact them, there will be someone who will jump in the portfolio and follow everything. So we also as if giving Finbar owners expertise guiding on bylaws, maintenance, compliance, and tenant expectations. We're also focusing on protecting our clients' investments, minimizing vacancy, and maximizing their rental return. And we also always explain that we're more than just property managers. We help our investors, our landlords with tax depreciation schedules, landlord insurances, maintenance, compliance, and connecting them with the right trusted professionals. So we also don't charge extra for that support. So that's how we value our work and support for you guys.
Okay, and look, one thing that I would say, sort of generally, if you're going to lease or sell a property in a Finbar project, stick with one of their panel of either property managers or agents, because an apartment is, a lot of agents sell in isolation, but you have to understand how the project works holistically as a machine, how those elements of common property and how the developer's theme is the value add, because the sum of the parts is much greater than the whole, especially when you come to bigger projects that have got significant amenity and significant common property, because that's the point of it. It adds to everybody's value by the virtue of having access to that lifestyle and those elements. And unless that can be conveyed, they're just selling or leasing a box of air in isolation, where you need to have and be able to deliver that value proposition in context. Now, I know that we've got people that are there where their apartment is coming towards completion. Are there things as a project starts to get to the very end that people can do to, put them ahead of the pack?
Sure. So although we're well known for apartments, management, we also manage a lot of residential homes across Perth. So we understand the different market and tenant demographics. And we don't automatically also recommend, furnishing every brand new apartment. Instead, we normally assess current market demand, target tenants and expected rental returns before recommending the strategy that will deliver the best outcome for each individual property. And also, sorry, I thought you wanted to add something. With an apartment or family home, we only get also one opportunity to launch a property as a brand new property. And we encourage always owners to have the property manager engaged well before your property is launched and before settlement, so everything is ready to go to the moment the keys are handed over to us.
Okay, thank you for that.
Yeah, sure, of course you can.
Sorry, can I just add? Just wanted to add on, if I can.
Yep. Yeah, okay.
Thank you.
No, you can.
I think exactly what Michelle said. The relationship starts with the property manager, in advance as possible, because for an owner, understanding what that sort of timeline looks like is really important for them, so that they're not going, oh, what do I need to do? I need to do this. I need to get all my ducks in a row. I need to, what do I do as far as insurance? And it really can be quite, for inexperienced investors, it really can be quite overwhelming. And so having someone to actually guide you through that process and go, well, this is what you need to allow for insurance, have you thought about tax depreciation, all of these things, so that when the property does settle, you're not suddenly going, have you thought about this? Have you thought, and they're like, oh, what? Sometimes they have thought of it because they might have done it before. But I think being able to step out the process and say, right, once we've got a settlement date, we can, really start sort of bullet pointing those things that we need to do. We can, lock in photographs. We can, do we need to do a clean? Might have been sitting there, might be a bit dusty. All of those things, so that when the green light goes, we're ready.
So can I add
Hit
something?
the ground running.
I also want to add, before the property is ready, we often send description and photos to our corporate clients and networking. So often we can rent the property off market before the property is actually ready. So that also saves you advertising costs and home opens. And when the property settles, then we've got a ready tenant to move in.
So it sounds like we've got the cash flow angle sorted out. All right, guys, I'm going to put this question to the panel, each of you individually. Based on everything that we've discussed, would you recommend that our hypothetical investor who's got the $600,000 property is now worth $850,000, they want to make another investment and they're wondering, how do I do it? What do I do? Do I buy existing? Do I buy off the plan? Should they move forward with buying a qualifying new apartment, an old apartment? What do they do? A yes, no, or a but? And what's your main qualifying single condition if it's not unequivocal? Abby, hit me. You can just do it with your thumb if you like.
Okay. Just going back to what Sven said at the introduction, as Warren Buffett said, hold on to your investments, right? So we're not selling investments just for the tax point of view, right? As soon as you sell, you crystallize the tax bill. Okay, so let's not think from the tax point of view. Is holding the asset, the investment, beneficial in long term or not? That should be the first question, right? If it's beneficial, we should avoid selling as much as we can. And then definitely the tax, concessions and the cash flow benefits are associated with new builds. So that's a very appealing investment currently. So investors should be leaning towards new builds, as long as it's a good investment, good product, good location they're buying. Tax point of view and cash flow point of view, it will be helpful. And yes, my gut feel and my personal position will be to buy investments,
Okay.
not just sit on the fence.
An accountant, you heard it first here, an accountant that actually didn't sit on the fence, gave you unequivocal advice.
Yes.
Not advice, an unequivocal view. Thank you for that. Ronald?
Gee, I don't know whether this is a trick question, but look, we have a supply issue and capacity to deliver. Just don't sit on the fence. We have a few projects coming on board. Have a look at it closely, because a lot of people tend to come in a lot earlier because they understand the market. And again, I'll say it again, the repeat buyers are increasing over time because they understand the market. Over time, during construction, they know it, that we've always given an incentive for people to come in to obtain the best price. And over time, we've increased pricing along the way. So I don't think the market will go backwards. Construction costs will continue to go up. Wages increases, material increases. If that continues and the prices don't continue to go up, then you can be sure that there won't be any new product in the marketplace, and that can't happen. Sydney's sitting at $1.2 million for a one bedroom or $1.5 million for a one bedroom. We've come up to about, 650, 800. We've got room to growth, and we're in the state with the resource sector. We've got a lot happening here. So just, I'm not selling. I'm just giving you good advice, because a lot of people have done very well with a lot of equity appreciation over time.
Thank you. So that's a yes from Ronald.
Look, I look at property investing very simplistically. I just look at it as a hedge against inflation. Whatever that headline inflation sits at each year, 3.6, 3.2, 3%, your property should be keeping ahead of that. And if you do owe money on it, you've got gearing on a new property. So that's a big, massive tick there.
Yep.
And that debt, as your property increases by inflation, your debt's also crushed by it. So that $800,000 that you might borrow to buy an apartment today, you fast forward 10 years down the track with inflation working against that, you've probably knocked 180,000 real dollars off it.
Yep.
Whilst had your property increase. So yes from me.
It's a yes from me.
Okay.
It's a yes from us as well.
Yes from you guys.
I really just concur with everyone that's commented before me, but really the current leasing fundamentals are favourable for investors, and when you've got such a quality product to invest in, why wouldn't you right now?
Yeah. All right, so guys, do we have any, before I conclude with my little bit, do we have any other questions for our panel? We'll be hanging around afterwards if you want to speak to us more privately, but in the glow of it, any hands, any questions at the back?
So we discussed about the demand supply equation. How does the rental yield look like in this whole scenario?
That's a good question, actually. No,
I didn't catch
the rental yield. So to discuss supply and demand, what are rental yields doing? Or rent values, let's say?
They've been, well, if we look at the last quarter or even since January, they have continued to increase slightly. If we look more closely at, say, the last few weeks, I probably would say that they've stabilised, depending on where and what the product is. But
12 months ago? I mean, weeks and months are very, very,
Yeah.
that's just noise. So where are they, compared, what are you seeing in those dynamics as far as the rent increases and appetite for rentals now to 12 months ago to 2 years ago?
The appetite is still very, very strong. But I would say that because the demand is still so high, and the stock is so low, we're not going to see anything really different for some time to come. So what we've noticed in apartment leasing is that we're still getting a very strong response. People are still very, very keen to view, particularly when a new development is launched and there's a lot of curiosity and everyone wants to have a gander and get in first. So yes, we're not seeing anything kind of slowing down. We've probably just seen, if anything, not rents decreasing, but more we might be doing, more than one home open before a property's leased, whereas, sometimes they weren't even hitting the market, or, first home open, we were processing, tons of applications. So probably just sort of stabilised a little bit, but demand hasn't slowed down.
Yeah, of course you can.
there are two types of apartments for sale now these days. As I said, there are the old-fashioned one, beautiful apartments, but with, as you said, swimming pool, car bay, pool, that's it. But now you see the new ones with everything under the sun. You know, it's a lot more like a resort than a movie theaters and spa and sauna and massage room and in capital appreciation. Which one would go better? What is the market trend going for? With the old-fashioned solid built with basic three, or these modern ones with all the facilities? What is the better investment?
Well, you can look at it like a brand new car and a second-hand car. You can buy a second-hand car that is cheaper, but doesn't have the bells and whistles of the new one.
No, this
But
would still be, as I said, it would still be new one. Two new apartments. One with just this three basic, and a new apartment, and another apartment, same, both new. The one with all the bubbles and frills and everything. I buy today a new apartment with basic. He buys a new apartment with all the frills and bubbles and whistles and everything. 5 years from now, what would be his capital appreciation compared to mine?
there's a few elements that go with it. I mean, there is obviously the strata
Purchase
levies.
price as well.
Yeah,
Have
purchase
you paid
price.
the same price for them? Because it a little bit also depends, what did you pay for each? So if one's got all the bells and whistles, you paid $3 million for it, it's going to be a different proposition to maybe one that, like Palmyra Western, you paid $750. So
It's just a percentage increase. That was capital appreciation. Not that value. Which one would be higher appreciation than after the two? Which would be have a better appreciation percentage?
well, it depends what you got in at, but
The strata levies ultimately. I mean, you have a lot more amenities, but then if it's a volumetric building, you tend to be able to see costs quite neutral or spread across. Whereas if it's a smaller building with less amenities, they might not be as desirable. If it's for investment purposes, I mean, if you want to rent it out and you're comparing it, and someone comes and compares the two, you probably get more people going to the ones with more amenities. So you get probably a better return or yield on the bigger ones. And someone might be willing to pay you more for a building with more amenities, which is usually the case because we've seen it with delivering Civic Heart and all that. People want that amenities and they're willing to pay for it.
So thank you for that, Ronald. You've got to look at it. I mean, do you think people want more stuff or less stuff? Typically, they want more stuff. You know, if you could have it and have a choice.
Sorry to interrupt. We see this on the rental perspective as well. Tenants asking if the apartment's got, you know, swimming pool, gym, because that's what they're looking for.
But also the theatre rooms, the pools, but also the business centres, etc. You know, if you could have it for the same price and it had the business centre in it and it had the breakout areas versus the one that didn't, which would you pick? Would you pick the one that had the stuff that had the stuff in it? So that's important. The other thing is people focus on capital growth a lot, in fact too much, because property accretes value in two ways, right? It accretes it in cash flow, which is the rental and the revenue that you're going to get, and that's what you put in your pocket at the end of the day. That's what you take home. Like we said about not selling, never sell, the problem with capital growth is you can't milk the cow, you've got to kill it to eat it to do that. You get to shear a sheep every year, you get to skin it once. And people need to think about apartments because that's the other thing. Capital growth's great, but what you're going to put in your bank every week, every month, every year is the rental income. So you've got to look at those as an accumulation index together to work out which at the end of the day is going to be your better proposition. So you need to sort of balance one out against the other. And the extra bells and whistles are unequivocally people want them, right? They pay more rent for the thing that has the bells and whistles. And you don't need, with compounding, very much in the way of a couple of % more as a rental yield over the capital growth to in the longer term make the one with a higher rental yield better, because you don't have to transfer your interest either via debt or sale to be able to access that, which is important. Increasingly, the market is becoming more sophisticated. I remember when stone bench tops were like a thing, right? Remember that? Like, oh my God, it's got granite bench tops, and it was like miraculous, and only on high-end stuff. There is enormous scope creep. What previously people accepted as standard, is becoming old-fashioned, and people want more than they previously had. I remember when apartments had pools and gyms. Oh, it's got a pool and a gym. And that was special. Now it's standard. Can you even buy a car with winding windows anymore, or anything like that? Like you can't, right? So that becomes the standard. So why do people pay more for things? Because they like it more, because they want it more, because they can see themselves living in it more. So you've got to ask yourself, if I had the money and I could buy one or the other, which would I prefer to buy? I'd prefer to buy, like, 2 properties are on the market at the same time, at the same price. Which sells first? Well, that gives you the answer on to which is more desirable. And let me tell you, you've got 2 apartments on the market at the same time, at the same price. One's got all the Finbar fruit, and the other one is just a block of 30 flats. And the other thing is how is it connected to your neighbourhood? And this is the important thing. It's a combination of rent. It's a combination of the facilities and amenities it had, but also not only how the apartment integrates into its broader facilities, but also into its broader environment. Where do I go for a loaf of bread, a litre of milk? How close is it to transport? And transport is a train, right? Buses don't really cut it that much, because older people, they want their mobility scooter to go onto it. They don't want to try to get up a bus, etc. So a train line is a very different transport proposition to a bus line in terms of desirability. So there's a whole range of factors that you have to look at. If it were me, I'd buy the one that had all of the bells and whistles, that was also well located and get a good aspect within, and then it becomes to the apartment itself, because not all things are created equal in the same building. Does it have nice northern light? Has it got good ventilation, etc.? If that helps. Okay, I'm getting the wind up. So we'll conclude with this. What's hot? Well, clearly it's anything that's new supply. What's not? Existing properties are clearly in the shade a little bit with regards to tenants and tax, etc. And what's next? What's next is up to you. A CEO of Goldman Sachs once said that the secret to success is not to be able to predict the future, because you can't, but it is to be able to recognise and react to the present more quickly than others. And to back up what Ronald was saying, if you're thinking about buying an apartment off the plan, do it now, because I get a lot of, let's say, Palmyra display, and they go, oh, the good ones have gone. Oh, but those ones 6 months ago were selling for X, and now they're selling for Y. It's called early mover advantage for a reason. So if you're going to do something, it's about action. It's about recognising the opportunity and taking it and being decisive, and not being, if you're thinking about selling, do it this financial year, this calendar year, because will there be probably more stock on the market next year as people kind of, the ones that are flip-flopping on the fence decide to make up their mind? It's all about recognising the opportunities that are present today and taking advantage of them decisively, because it's a lot easier to be first. Ladies and gentlemen, thank you for your time tonight. That's all we have. Well, that's all I have here in the panel. I'll release them now, but we'll be hanging around a little bit afterwards, so feel free to come up and talk to us, and don't forget your show bags. Thank you very much.